Right now, as you watch this, the ground beneath the global economy is shifting. Every single second, the United States government is borrowing roughly 71 dollars. That is not a typo. Our total national debt has officially crossed $38.43 trillion, an increase of over $2.25 trillion in just the last year. For decades, the US dollar has been the undisputed king of the financial world. But in 2026, that crown is looking heavier than ever. Today, we're diving into the data to see if the dollar is truly facing a collapse or just a profound institutional re-indexing. From the massive internal erosion of our own debt to a secret technical war being waged by the BRICS nations, the greenback is at a crossroads. The debt supercycle and the one big beautiful bill. The biggest threat to the dollar isn't coming from overseas, it's coming from inside the house. At the start of fiscal year 2026, the U.S. borrowed a staggering $439 billion in just 2 months. That is $7 billion every single day. We are currently spending nearly $1 trillion per year on interest payments alone, a figure that now exceeds 13% of all federal outlays. The main catalyst for this acceleration is the One Big Beautiful Bill Act, or OBBBA, passed in 2025. While it acted as a massive stimulus, analysis from the National Bureau of Economic Research warns that this bill is projected to push our debt-to-GDP ratio to a massive 183% by 2054. If the temporary tax provisions in the bill are made permanent, that ratio could soar to 199%. To put this in perspective, economists say we would need permanent spending cuts or tax increases of roughly $827 billion every year just to stabilize our debt at 2024 levels. The technical de-dollarization of BRICS Plus. While we've heard politicians talk about a de-dollarization for years, it has finally evolved from rhetoric into a sophisticated engineering project. The expanded BRICS Plus coalition is no longer just trying to replace the dollar with a single currency. They are building parallel plumbing to bypass it entirely. The most tangible threat is Project mBridge. This platform connects central bank digital currencies from China, the UAE, Thailand, and Saudi Arabia, allowing them to settle trade in real time without using the US dollar-denominated banking system, or SWIFT. As of early 2026, mBridge has already processed over $55 billion in transactions, with the digital yuan making up 98% of that volume. However, the US is hitting back hard. President Trump has explicitly warned BRICS members that any move toward a common currency will be met with 100% tariffs on exports to the United States. This has forced countries like Brazil and Russia to publicly downplay the idea of a BRICS currency, even as they continue to build the technical systems like BRICS Pay to settle trade in their own local currencies. The Gold Flippening and the Federal Reserve. If you want to know what central banks really think about the dollar, look at what they're buying. For the first time since 1996, the market value of gold held in global reserves has officially surpassed the value of U.S. Treasuries. This flippening signals a massive shift from government-issued debt to neutral, non-printable assets. Analysts are now forecasting gold to reach as high as $5,000 per ounce by the end of 2026 as central banks in Poland, Brazil, and China continue a record-breaking 4-year buying spree. Compounding this is the drama at the Federal Reserve. Chair Jerome Powell's term expires on May 15, 2026, and the selection of his successor has become a major source of market volatility. With the Department of Justice currently investigating Fed leadership over administrative costs and the executive branch publicly demanding deeper rate cuts, investors are terrified that the Fed's independence is being eroded. Any perceived loss of Fed independence could lead to a systemic repricing of everything from your mortgage to the value of the dollar in your wallet, the black swan, and the AI bubble. Finally, let's talk about the black swan that could crash the party. The US dollar is currently being supported by a liquidity moat created by the AI investment boom. With up to $3 trillion projected for AI infrastructure, global investors have been pouring capital into American tech giants like Microsoft and Google, creating a floor for the dollar. but 26% of major investors believe the biggest risk of 2026 is an AI stock bubble burst. If those trillions in investments fail to generate enough profit, a stock market collapse could force the Fed to cut interest rates back towards zero. In that scenario, the US dollar index could crash below 90, destroying the dollar's yield advantage and potentially accelerating the transition to a multipolar world. The cleanest dirty shirt. So, is the dollar collapsing? Most institutional analysts say no, not yet. Because rival economies like the Eurozone and Japan face their own stagnation, the dollar remains the cleanest dirty shirt in the laundry. Legislation like the Genius Act, which integrates the dollar into the blockchain via stablecoins, is actually creating a massive new demand for US Treasuries. But make no mistake, the dollar's absolute monopoly is over. We are entering a fragmented era of digital ledgers and physical assets where a world anchored to a single sovereign is becoming a thing of the past. Now I want to hear from you. With the national debt growing by $71,000 every second, do you think the US can ever truly close its fiscal gap? Or is a currency reset inevitable? Let me know in the comments below. The biggest threat to the dollar isn't coming from overseas, it's coming from inside the house. At the start of fiscal year 2026, the US borrowed a staggering $439 billion in just 2 months. That is $7 billion every single day. We are currently spending nearly $1 trillion per year on interest payments alone, a figure that now exceeds 13% of all federal outlays. The main catalyst for this acceleration is the One Big Beautiful Bill Act, or OBBBA, passed in 2025. While it acted as a massive stimulus, analysis from the National Bureau of Economic Research warns that this bill is projected to push our debt-to-GDP ratio to a massive 183% by 2054. If the temporary tax provisions in the bill are made permanent, that ratio could soar to 199%. To put this in perspective, economists say we would need permanent spending cuts or tax increases of roughly $827 billion every year just to stabilize our debt at 2024 levels.